morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. With me today, Jeremy Rettich with Virtue Capital over in Brentwood, Tennessee. And we've been talking about this stop-loss strategy as a way. First, we talked about this is a way in a bear market that you can help basically protect yourself. So in a really down market, when the market has dropped, the S&P 500 index has dropped more than 12% or closed at a negative 12 or more in a given day from its highs, that it's going to push you out, basically get an alert. We're going to push it into bonds, out of equities. Now, let me just give a quick aside on this. Keeping in mind, this again is why this is not a do-it-yourself workshop, okay? This is where we want you to seek out information to get help doing these things, not to just try it on your own. And one reason is think of tax implications, okay? So when we're talking about the stop loss, there are some trade-offs, and this is where retirement accounts, IRAs, 401ks, that kind of thing, this can be especially helpful. Now for us, someone's left the workforce, they've come, and at that point you're not likely to have left your money in your 401k. You don't have as many investment options. You certainly don't have access to these type of strategies. So we're typically going to have that rolled into an IRA, and that's where this can be applied. Okay, this isn't something you can apply in a company plan. In fact, many of the different strategies we talk about, equal weight index, you won't find in a company plan. This is one of the reasons that when you leave that employer, okay, one of the pluses is, of course, if you're getting any matching, you want the free money. If you're the ability to put more money away on a tax-deferred basis, so depending on your tax bracket, that could be very important. But then once that's done, once you've retired, once you've left the employer, now we want to roll that into our IRA, and now we can apply these kind of strategies. And one of those, and the other part of this, by the way, we talked about the individual investor and how well they do in the market. Because of the emotional part, as Jeremy alluded to earlier, that comes into play. People get nervous, they get out of the market when the market drops or starts down. They don't know when to get back in. They sit out typically too long, and they end up getting much less of a return. This is why, either a buy and hold, which if you can handle that type of risk, the volatility that seeing your accounts drop that much and be able to ride it out and stay disciplined. When you're saving for retirement, that's easier to do. When you're in retirement and you know that's your nest egg and that's all you've got, that's a little tougher. Okay, so Jeremy, this is one of those, the individual investor, we can put that graph up. Average investor is 2.5 from, let's see what we have, 1999 through 2019 in that period. Let's go ahead and Marilena and get that graph up if you would, please. They're showing average investor at 2.5%. Actually, I think she did step out.
Just above inflation, Hank. I mean, that's literally where they're at by a couple of basis points. So point being, and we'll pull the chart up in here in a few, but the average investor, we're all creatures of emotion, right? We make decisions in our personal life, our professional life, and certainly in investing. And so that's why I think it's important, Hank, you touched on it, whether you're doing modern portfolio theory, you likely need to just stay the course and ride it out. I mean, if you can have that much risk, you certainly should do that. That's the plan. But most don't. And when you look at 2.4% return for the average investor over 2 decades, over 20 years, it just goes to show you that they're buying high and selling low, and it's just not working for them. And that's why it may make sense to have a mechanical approach. And I will just touch on and say, stop loss is one of over 100 strategies we have, right? Excellent. We have many money managers on the platform, many options. This is one of many. We believe in, just like Hank, you do, having as many options as possible so that depending on the environment, depending on the client, the situation, that we have different options for them on a go-forward basis, not looking backwards.
This is one of the areas we all have to have a plan for how we're going to approach retirement, how we're going to approach investing. I've talked for many years about the buy and hold strategy, about modern portfolio theory, about staying disciplined through market ups and downs. Part of how we do that is we make sure you have an income plan. So in other words, if you're going to be, as you're in retirement and your portfolios may be going down during a bear market, we don't want to necessarily be tapping those. We're going to have an alternative set up to provide the income. So an example of that might be we might do a laddering approach. We may have a conservative portfolio down here for the first, say, 3 to 5 years worth of income, and then we can invest more aggressively in equities for the growth that we need to stay ahead of inflation and taxes. And we just keep balancing those out out as we go forward in retirement. So this is one of the areas when you're looking at, in fact, the individual investor, Marilyn, we'll go ahead and get that graph up. This is the one we were talking about. And right after this, there's another graph that'll speak to these ups and downs in the market. They're going to occur. If you're going to be invested in the stock market, bear markets are going to be a part of investing in that market. We've had 3 of them in the last 20 years, substantial ones, from 34% to 55% losses as far as the market. Now, I say that as long as you stay invested, they have come back, invested properly, okay? When we're talking about portfolios with thousands of holdings in them, that's another key piece to this, not just a handful where you could get more in trouble, all right? But if you're invested properly, yes, even Warren Buffett, when asked, what's the market going to do next month, next year, he's like, I have no idea. Right? Any honest person would say that, even maybe one of the greatest investors in the world, and in all time even. And what does he say? He says, I don't know what it's going to do next month, next year, or even the next 2 years, 3 years. I do know over the long term it's going to go up. And that's what you have to understand with the free market system. That's what we're going to see. In fact, in the next slide, the S&P 500 index at inflection points. And Jeremy, this is to this point about bear markets and bull markets. We're going to have those.
We certainly are, and we've seen it in the past, and we're going to see it again. And that's why, you know, blending different strategies, whether they're dynamic or tactical, meaning they can go risk on or risk off, a portion or wholly, as well as buy and hold. You know, blending them together over a full market cycle, historically speaking, would benefit you. So it's not one against the other. I believe that they can collaborate with one another, and it's probably hard to see here, but the most recent run-up that we've had since the bottom on March 9th, 2009, we saw a 401% increase in the S&P 500 until we hit a high last year, February 19th, and then we saw in 22 trading days a 34% decline. And then since then, through the end of the year, from that bottom, we're up 68% through the end of the year. But you can't see here, but there's trends in the market, right? We were from 96 to 99, up about 100%. Then over a couple years, we were down about 50 and then back up 100. And so the point to this slide, what we're sharing is there are definitely periods of time where there's prolonged downturns and large run-ups. So again, to my point earlier, is blending risk on, risk off strategies with those that just buy and hold. I think for many clients, certainly not all, but for many clients, over a full market cycle, so bull bear cycle, it would benefit them to be invested not just in one camp or the other, but to blend them together, and further diversification is the way to go.
You know, we're always looking to improve upon the principles and the things that we do. So when it comes to your investment portfolios, much as I've talked about buy and hold, much as I talked about modern portfolio theory, we're now seeing additional research, new research that's showing us some ways that we can improve upon that. What's our goal? Market return with the least amount of risk. And now we're going to share, when we come back from this break, a little bit about some safe money strategies that can be added into that mix as well. But first break, join us here. We'll be right back on the Retirement Report.